Hey there, everyone, and welcome to the latest edition of our Market Misbehavior podcast. I'm your host, Dave Keller. Excited to bring you my latest conversation with a top market practitioner. Our goal with this podcast is to sit down with people that know the markets well, technical analysts, money managers, strategists, authors, educators, and unpack some of their lessons learned, try to tease out as much investment wisdom as we can in a short conversation, really think about the market environment, what they're learning about the current market environments, how they're positioning or what their expectations may be, and how those expectations may be changing at the time of our conversation. Today, I have a really fun one to share with you. Frank Cappelleri is the founder of CappThesis. Frank's had a great career. He was at Instinet for a number of years, which is when I first connected with him. But he actually started in the late 90s with the great Alan Shaw and Louise Yamada at Smith Barney, one of the legendary sort of technical analysis sell-side shops back in the day. And really interesting to have grown up at a similar sort of pace. Frank started in the late 90s. I started right in 2000, but sort of checking in with Frank over the years and watching him grow into really a top strategist has been a lot of fun. He's one of the genuinely nicest people I've met in the industry and in the technical analysis community for sure. We talked about his S&P 6100 target, which here in mid-December may end up being almost a perfect call. He made that earlier in the year, and the market sort of followed it up really well. So we talked about how he developed that sort of crazy upside objective, which seemed pretty unrealistic at the time. What the conditions, how the conditions evolved through the course of 2024 to really make that objective achievable, and then talked about looking forward and what sort of expectations he has for 2025. We talked about the dominance of the Magnificent Seven, growth versus value, some of the charts he'll be watching to identify a potential leadership rotation amidst breadth conditions starting to deteriorate here. The importance of relative strength came up a number of times, thinking about macroeconomic themes like interest rates relative to charts. Thought he has some interesting ideas there. And, again, just really interesting talking about sort of lessons learned over a successful career. And he really reminded me one of the great benefits you get from being in the industry over time is just the experience of having weathered previous bear markets. Back in financial history, if you look back, 100% of bear markets have been fully retraced back to their previous highs, right? We know that because the S&P is at all-time highs. So a great conversation today, really focusing on the general trend in the market, some of the signals we're seeing here in late 2024, and what things we should be looking for in 2025. So please enjoy this conversation with Frank Cappelleri of CappThesis. All right, it's a pleasure to sit down virtually with Frank Cappelleri of CappThesis. Frank, good to see you again. We're looking back at a year-end. How are you these days? Okay.
Dave, thanks a lot for having me. Congratulations on this new podcast. I've been a fan, watching every week.
No, it's been awesome to have you, to be able to interview you over the years, Frank. And as always, I think you bring a great sort of a perspective, a great institutional experience, great knowledge that you're bringing along with you, but you tend to package it in pretty digestible comments and insights. And I think we all will benefit from a little time with you here today. Obviously the major averages, sort of at or near new all-time highs, the NASDAQ composite around 20,000, S&P hitting 6,100. As you're looking back at where we're at now versus where we've been, any surprises in 2024? Are you surprised by the strength of the market that we've observed between early days and where we're at now?
I think we have to be impressed by it. As you know, Dave, 2 years worth of uptrending action. Now, has it been a straight shot higher? But the pullbacks along the way have been relatively contained, and we can point back to some of the most non-volatile trading environments. And 2024 seems unique, but you remember 2017 as the S&P rode this uptrend and only pulled back from a new all-time high about 3%. Only had 1% moves all year back then, right? And so I think we've seen this before. And the point is that we started this process coming out of 2022, major volatility event in 2017, got through 2 years of volatility. So, the market ebbs and flows like this, but over history, over, decades, you tend to see bull runs last longer than bear markets, even though the bear markets, of course, occur very ferociously and it comes with a lot of volatility all at once, it usually gives birth to something like this. So it's not about trying to time when this is going to happen. We try to look for character changes. And, I look at that via classical patterns first and foremost.
There's a bunch of investment wisdom in those comments that you just made. And it's true. And I remember talking to people like Ralph Acampora and others earlier in my career. And I think as a novice sort of thought, is the market bullish or bearish, and implying that there's sort of an equal distribution. On average, the markets kind of are going up, right? And over the long-term history, the trend has been pretty positive. So, being short or being bearish tends to be good for a limited period of time, and then that usually changes. I'd love to, Frank, highlight, congratulations, I think, are very much in order. CNBC, where we're both contributors, recently sort of highlighted your pretty decent upside target for the S&P around 6,100, which is pretty awesome. Congrats for sure. Can you talk to us a little bit about what sort of gave you the inspiration, late 23, early 24, to even think about that as a potential upside target?
Right. Thanks a lot, Dave. Well, I think we can all agree that both of us are not there to pounding the table and making wild calls just based on what we think could happen, right? So technical analysis, I think, is very good in that it gives us a set of rules, strategies, different things we could look at to help us get there. And one of the things that really appealed to me, like I just mentioned, is that patterns make sense. Simplistic measure moves are a simple concept to understand as well. Now, the part about that is this can be applied, of course, to patterns across different time frames. We could look at an intraday chart and it could look just like this, and having a target that's 10 points higher of something that's with a 10-point range may seem extravagant for that time period, just maybe as this one would as well. But kind of like we're just talking about with volatility, how was this target, how did we get this? Well, we had to actually have a pretty substantial fall from 2021 high to this 22 low. And so from that point coming back, again, it seems like a straight shot all the way through, but we know that wasn't the case. And just having a dip or so as the market was getting back up to, say, that 4,800 area, in my mind, created the right shoulder of potential inverse head and shoulders pattern. And the way breakouts work, right, they're tentative until we see some follow through. And I think the best part and the most important part about this move was what came right after. So that breakout happened in the middle of January of this past year, 2024. And then we had 3 more weeks upside movement. And, we only had 1 down week the whole time in the middle of January, but that produced a cushion, if you will, right before March began. And that obviously gave us the ability to have the market experience some bouts of volatility and keep that breakout in play. And so as it went on, I got a lot of questions about, like, how can this continue? And the answer was always, seeing smaller patterns play out will get us there. And all along the way, by my count, there's now, including this one, 11 successful bullish patterns that have been formed and had their targets hit since the 2023 low. 9 of the previous 10 all happened after this breakout, meaning that you had a consolidation period resolved to the upside. And I always say, anytime there's a consolidation period, it's a jump ball. It could at some point become a negative reversal. It's not us to try to guess which one that is, but once it finally happens, that could tell us that things have changed. So for now, I don't see that out there. I see the market continuing. There are 2 more targets right now with a different bullish patterns I'm watching, 6180 and 6200. One of them may not work. So I think we have to take this, in its entirety. Yeah, 6100 was great, having that target hit 11 months later, but it was really just, a compilation of other smaller iterations of patterns like that working out too.
You and in the work that I follow your work as closely as I can, and I know a lot of times, Frank, you highlight some of those shorter patterns, and I 100%. I think what you're talking about is after that breakout, a lot of smaller kind of continuation patterns, little pullbacks, and then breakouts that confirm we're still in an uptrend. Are you seeing those kind of patterns now? I mean, I would say in December 2024, you highlighted, January, where we kind of broke out January, February. That was sort of the last time the Magnificent Seven kind of mega cap growth trade just really steamrolled almost everything else. We're kind of seeing that again here, right? In December of 2024, a lot of other things are rotating lower. I mean, does that give you confidence or hesitation about further upside, I guess, going into Q1?
Yeah, it's a great question. I think we've obviously seen leadership come from Mag 7 like more often than not over the last 2 years. At the same time, every time there is a mean reversion trade, right? Whether it's small caps, whether it's just the equal weight RSP, S&P 500 ETF doing well, there's always the temptation to call the move to say this is going to actually turn. Most recently, right after the election, right? We heard about there's going to be tariffs on the big companies. There's going to be a really big stress on getting industrials and materials back going. And those areas started to rally strongly while big tech took a little bit of a break there. That was only for 2 weeks, and now making new highs once more. But what I think is interesting about the large cap growth right now, because if you look at the Mag 7, it obviously has done very good, the Mags ETF, NDX making new highs as well. Well, the difference I saw, and it's kind of slight, but maybe look at it a little bit more just this morning, was that the Mag 7 ETF it has an RSI, or this morning it was close to 80, obviously very high. NDX making highs as well, didn't get overbought yet. It was only at 68. So again, not a huge difference, but you have the same names driving this. And the major difference is that the NDX has semiconductor contribution of 22% weight within the index, right? And as we know, semis have been underperforming. So you think about all of the stress on large cap growth right now, and you have a major part that has underperformed for the last 3 or 4 months. Now, we could look at this as a huge negative divergence that's eventually going to lend itself or going to affect the rest of the market, or saying if this starts to get going again, if NVIDIA can find a bid and the rest of them do as well, then you can just add this on to potentially another up leg on top of the large cap growth move that's already in place.
It's really interesting. And at the end, you talk about kind of a catch-up trade of sorts, right? The mega cap growth is working. What are some of these other areas of the market that are a little less strong, as evidenced by the equal weighted S&P coming off? What if those start to catch up? And that's kind of what happened, I would argue, probably in the spring of 2024, right? Sort of everything else started to participate. When you're thinking of positioning going into the beginning of next year, how do you balance, waiting in these leading names that just keep getting bigger and bigger, the Metas and Amazons, versus other areas of the market that, probably are more tactically weak, but, longer term strong? Where do you see opportunities, I guess, positioning wise going into Q1?
Well, I look at the S&P 500's 11 sectors. You have technology, communication services, consumer discretionary, growth, right? Obviously all growth. The rest in my mind is the field, right? What is the rest of the field going to do? Because altogether, they still, the influence is not going to be as much, whether you're talking about just from a mathematical perspective or psychologically for that matter. But that being said, there's been a lot of talk, of course, like with the biggest names leading, but really the bedrock of this entire, move over the last 2 years has been rotation when has been needed the most. And anytime that or shouldn't say anytime, but most of the times in 2024, when say technology was a lagging sector, more often than not over the course of a few weeks, that's when the rest of the market stepped up. And when I look at this on a daily basis, some of those times, especially in April, you had a good amount of time, but the breadth wasn't that bad because it was showing that there was interest in industrials and financials. So I think we're at that point now, because coming into today, the S&P 500 has yet to have a positive breadth day for December, right?
Right.
So 8 straight days, which has been the longest run over the last 2 years, where the S&P itself was only down 1 or 2%. The RSP equal weight ETF is down only about 3% though. So even though we haven't had strong, really, really good breadth, it hasn't been extremely weak either. So to me, that just shows a pause within some of these sectors, Dave, like you just mentioned, that I do think when some of the large cap ETFs or large cap growth stocks are short-term extended, it's a perfect time for that rotation to come back in, at least on a tactical basis.
What you mentioned a couple things about the weaker breadth. 100% agreed. The equal weighted S&P, which we're looking at here, coming down while other things are sort of remaining elevated. What kind of charts or tools or indicators would you use to sort of identify that some of those other areas of the market are improving? Is it change, is it an improvement in breadth conditions, which have maybe been less ideal in December? Is it looking at, those other sectors like industrials, more of the cyclical sectors, and looking for improvement in some technical way? Like what kind of charts would you look at to sort of make that assessment of, okay, growth is now being joined by these other areas of the market?
Right. I think just looking at normal relative strength lines is
Yeah.
obviously a great start
Yeah.
for that. But a lot of them too have done a very good job of breaking out and then coming back down and respecting breakout zones. And I think a great example of that is like the XLF financials ETF. Along
Yeah.
the way, I think we're at like 6 different pattern breakouts since the springtime, and they've all like hit their targets, not huge amount, right? And then come back in, and the XLF has then reset itself and gone higher all along, making new all-time highs all along, finally getting through the 2021 highs, but of course the 2007 highs as well. So I think that's the extremely great example. It's obviously done very well post the election, even before that. So I think it's set up well, and it's something really we need. Financials, industrials, of course, probably the 2 biggest ones that we need to see continue to accept some of when the capital gets deployed there, if and when the next time we see a pullback in technology and the like.
You and I both, Frank, I think look at the markets primarily through the lens of technical analysis, but we have to have an awareness of other disciplines and how that fits into the big picture. Working with money managers, which we both have done. Talk to me a little bit about the interest rate environment, because we've got one more Fed meeting next week. The yield curve is now kind of coming out of an inverted shape and more of a normal shape. How do things like interest rates, the dollar, how does that inform your analysis of the markets? Do you prefer to just look for changes in the charts as evidence of a new theme? Or how do you combine some of those macro disciplines or other asset classes into your analysis of an ETF like the XLF?
Yeah, great question, Dave. I think one of the things has been most interesting over the last 2 years is that you go back to 2022. We know that was a bear market. It was driven arguably by inflation and rising rates. And so during that time, again, huge amount of upside movement in both interest rates and also the dollar. As a result, the S&P 500 went down. It was the easiest scenario to see, and that changed, of course, by the time September, October came along in 2022. So the same type of thing when we had the pullbacks in 2023. But this year, much different, right? We've seen most of the time, a good amount of the time, the dollar rising and yields rising, and the S&P 500 able to rise along with it. And so one of the things that strikes me about that is, number one, why is that? I haven't really heard a good explanation yet. But looking at the charts themselves, one of the things that stands out is that even though we've had this strong move in the yield higher in the dollar, they haven't made any new ground on a 2-year basis. Both range bound still below their high. So I think the market, the XLF, whatever you want to look at it, pays close attention to obviously how strong those moves are, number one, but of course where they are along the most recent range as well. So I think if these moves continue and the 10-year yield keeps on moving higher, right, gets back to closer to 5%. If the dollar finally breaks through that range and stays 8, 9, 10 at that point, then I think you're going to have a real reason to believe the S&P 500 should finally have another type of corrective activity. Other than that, though, we've seen that the market has been okay with those just kind of going back and forth for now. And I think 2025 may be different. We'll see, but I think that's going to be one of the most important things to look at, to see if those ranges continue to hold into next year.
I'd love to ask you, Frank. I mean, with charts like Meta and others that have had these, incredible runs, right, in 2024, and a number of these are just, just continue to break out, similar to what we talked about with the S&P and one of the first charts we talked about. From your perspective, how do you handle a stock like this? I feel like a lot of viewers, a lot of listeners are probably sitting on paper gains, hopefully, in charts like this that have just been working. What do you do, or what part of your toolkit helps you stick with trends that are working and I guess avoid giving it all back, during that next pullback, which is probably going to happen at some point? Like what sort of things do you use to follow trends effectively?
Well, I think we have to realize what type of market that we're in. And so we can talk about an uptrend, we talk about being overbought in an uptrend. Shouldn't be an ominous thing, right? Because we've seen it over and over again, whether it's oscillating back and forth between a 70 RSI or just having continuous DeMark 13s hit. It doesn't mean that those indicators are useless. It just tells us what kind of market that we're in. And going back to 2017, I think was a very instructive year, at least from my perspective, because I was struggling with that along the way. I was like, how can the market continue to rise like this and continuing to be pinned over ball conditions? And so that's when I started to look at it a little bit differently. Like what always changes? What is the one constant that we always see, when a market that's rising eventually starts to roll over? Well, guess what starts happening? Bearish patterns start to work. Those consolidation levels, those consolidation periods tend to be resolved to the downside. Now that sounds overly simplistic, but guess what hasn't happened over 2 years? We haven't had a big bearish pattern play out. In fact, I tracked these very closely. There's only 2 of them that happened across 2 years. And when those occurred, we still got the bid coming back. So with something like Meta, and I've even put NVIDIA in there because it's a very important spot right now. I think everyone can tell it looks like a potential bearish pattern. There's like a potential head and shoulders pattern, right? And so I think it's very enticing to maybe say, oh, well, this is the end. But you may recall what happened 13 months ago. A very similar looking pattern that actually got a downside break in November and then gave way to like another massive run for an NVIDIA. Now, I'm not saying that is going to happen again for that, but this is the type of thing you have to look for. If NVIDIA eventually breaks down below that neckline and eventually hits that target, it's going to happen quickly and it's going to have a reverberating effect on the rest of the market, in my opinion. But we don't see that. We don't see topping patterns play out. You may have to give yourself a little bit more leeway as opposed to just a stop loss. It just tells us that as normal consolidation within a long-term uptrend still.
I love that answer. And thanks for highlighting NVIDIA, particularly like that October, November of last year, right? It almost looked like it was going to break down. And that ended up being the beginning of just this incredible, almost record-setting 2024, I feel like, soon after that. That's a great point. Frank, a question you and I have talked in a number of different interviews, and a question I've been dying to ask you that I'm excited to be able to now. You've had a great career working with a lot of different customers in a lot of different areas, and now, of course, running CappThesis as your own shop, which I'm thrilled that you're able to do. I'm curious, when you draw on your experience, what sort of formative events or what did you gain from those earlier experiences in your career that I guess help you analyze the markets or trade the markets more effectively today? Can you give us an example of that?
Yeah, well, there are a number of them over 20 years worth. But one of the things that you and I both experienced were 2 big bear markets, right?
Yeah.
And the internet bubble bursting and the great financial crisis more so. And great financial crisis was much more prominent in my eyes, only because I was older a little bit more. And, everyone experiences this, but we were sitting on a trading desk like that. You see the chaos in real time. You were concerned for your clients, you're concerned for your own, personal job at the same time as the industry as well, right? But so I was talking to a client at that point who had been in the industry for 20 years longer than me. And what he said to me during that time was, keep your seat. And I asked him what that meant. He's like, just keep your seat. I'm like, well, how am I going to move? The firm goes under. He's like, stay calm. This is going to pass as well. And there's going to be another market on the other side of it. And so whether you're talking about one's career or the market, there's one constant, and that's change. We know that something's going to change once more. So I think it's especially true for right now. And I know that you were talking about that with Ari Wald recently on a podcast, and like, we can't get too comfortable with this type of environment because there's going to be something out there. It's an unknown now. And so we have to expect the unexpected. At the same time, expecting this uptrend to end just because it's due is also something probably we shouldn't do. So I think you just have to be ready for everything. And I think if you're managing active positions like that, you just have to identify some levels before they get there, whether it's something you're waiting for a pullback. Is it going to be on top of a support zone that should hold, whether you're using moving averages, whatever it is. I think understanding what those parameters are before we need to helps us just take emotion out of it. We can never remove emotion completely, but having something set before we actually need to apply it in the thick of things is a big advantage.
I feel like those, I don't want to say visual scars, but those emotional scars you have from weathering different bull and bear cycles, right? I think that in many ways probably shapes the way that we think. When did you start in the industry, by the way? I don't know if I know that.
I got my first job in 1997, working with Louise and Alan Shaw, right, at Smith Barney. So that was middle of the internet bubble. When I think I mentioned this story before, but the one thing I got from that was overbought is great. Right? It's like, give me nothing better. And I started at Instinet the week before the NASDAQ topped. So I was like, wow, overbought is it's not good anymore.
Oh, that's funny. And when I give presentations, I always like to show a chart of the S&P 500 from when I started, which was June of 2000 to the present day. And it's mainly to just show that the longer you're involved in the markets, the longer you've experienced those big swings to the upside and to the downside. And just, I feel like you have that memory of this happened before. It might not be exactly the same. We don't know what we don't know. But that experience of recognizing that there's another side to that bubble, as you kind of described, I think is really well put. Frank, tell us a little bit about what you're doing now at CappThesis. What sort of work are you focusing on day in, day out?
Well, we put out daily content, for our clients, which include institutions, financial advisors, and as active investors as well. So we try to, stay one step ahead of the market, not making predictions, but understanding again that we're in an ebb and flow type market, and whether it's short term or longer term, and this is done across different pieces. We have some strategy pieces, we have pieces that just look at individual stock picking, with identifying where the breakouts or breakdowns are, identifying where the targets are and where risk levels are as well. And so with that, I get a lot of great feedback from our clients, and feedback is great because it tells you what's working and what's not. And so I like to think because of that, 2 years after starting it, we're a better place now than we were there, and I'm excited to see where it's going to be in 5 years from now too.
That's awesome, Frank. And I know your website's CappThesis, CappThesis.com. You have a YouTube channel as well, right? What is that called?
Just search CappThesis on YouTube and it'll pop up.
Perfect. Frank, listen, great to see you. Thanks for sharing a little investment wisdom, some good reminiscing about some painful experiences in our professional careers, but hopefully preparing us well to navigate these markets going forward. But thanks for coming on. I hope we can catch up in the new year.
Dave, thanks so much. Appreciate it. Talk to you soon.
Well, I'm sure you picked up on the fact that Frank is just one of the nicest guys. What a thoughtful, genuinely, awesome person to talk to. It was a lot of fun. It's great. There are a couple of those big sell side shops that used to really be thriving, right? The Smith Barney room with Alan Shaw, Louise Yamada, and others. The Merrill Lynch room with Bob Farrell and many others that came after that. And most Ralph Acampora in the shops that he ran at Prudential and elsewhere. And Kidder Peabody and Knight. And what's interesting is so many of my current peers in the industry overlapped with those different shops back in the day. I had the benefit, I think, of being able to spend time with all of them in my role at Bloomberg, because I would call on all of them as customers of Bloomberg. So kind of got to know all those different groups at least a little bit. But a lot of fun talking with Frank about his own experiences. And really, you can see when he is talking. If you ever got to know Louise Yamada, who thankfully is still with us, the late Alan Shaw, unfortunately, who passed away earlier this year. If you got to spend time with them, you will pick up in Frank's approach a lot of those, tried and true technical approaches that Alan, Louise, the other giants of technical analysis have been using for decades. So awesome to see Frank applying those same concepts and techniques here in 2024. I really appreciated Frank's discussion and a lot of the charts that he posts when I see it on CNBC Pro, and also with his own research called CappThesis. He talks a lot about some of those short-term continuation patterns, short-term pullbacks, and how they resolved. And he often reminds me when I see his charts, I remember about the benefits of looking for those short-term sort of validations that an uptrend is still in play. And I think he illustrated that hopefully very well in our conversation. You can find more about Frank and his work at CappThesis.com, CappThesis.com. That's it for today's episode. As always, very interested to hear who else I should talk to as part of this podcast series. We've got some great guests here in December of 2024. We're lining up some awesome guests for Q1 of next year, and I'd love your ideas. So wherever you're listening to this podcast, drop a comment and let me know who we could talk to. I'm happy to try to chase down anyone I can to have a great conversation. As a reminder, if this presentation, if this discussion sort of piqued your interest in technical analysis, in learning to analyze trends and price momentum on measures of breadth and sentiment and how they relate to other financial disciplines out there, our Market Misbehavior premium memberships could be a great way to supercharge your own understanding of the markets. Here around the holiday season, what better gift to yourself than the gift of mindful investing going into the beginning of next year? You can go to marketmisbehavior.com/premium to find more information about those premium memberships. A lot of great things included in there, including an active members-only community, some premium members-only reports like our weekly flight plan, which we put out every weekend, and virtual courses to help you understand the technical toolkit a little better. Don't forget to use the code PODCAST for a special deal in the first 12 months on any plan. That's it for today for Market Misbehavior. I'm Dave Keller, and remember, it's always a good time to own good charts.